what I want to do is take you through a few slides really to help you think about the role of investor education in making markets work and ensuring that consumers have the products and services that they need. Because I think this is a really, really important piece of context to understand. Because all regulators, regardless of where they exist, have got very, very limited resources to actually intervene and make markets work. And if we are going to use investor education or financial capability interventions generally as an intervention, then we have to be really, really confident that what we're doing is effective and actually works in delivering the objectives that we want to achieve. Now, I don't know if people can actually see this slide. I'm sure there'll be handouts later, but before just to set a bit of context here, it's really before you actually embark on any initiative or before you develop any strategy, it's first of all really, really important to understand what you're trying to achieve, and that means being clear about what a successful market looks like, and therefore what regulators are trying to achieve as well. And at the FSUG, at the Financial Inclusion Centre in London, we use a number of market objectives, consumer outcomes that we use to measure whether markets are working for consumers. And I'll just pick out some of the important objectives. I mean, we clearly want to see markets that are safe and secure and financially resilient. We want to see markets that operate with fairness and integrity. But I think most importantly from this debate really, we want to see markets that are efficient and truly innovative. Now, I stress that because there's a big difference between markets that are truly innovative and markets that create the illusion of innovation. There are hundreds of suppliers in the European Union of investment services. There are thousands of asset management products, but that does not mean that those products and services and those firms are actually efficient or markets are actually innovative. And if you want a sort of a real consumer test of what innovation means, then we say that true innovation is socially useful if it improves consumer welfare by reducing costs or enhancing value. It helps people manage their risks better. It improves access to markets. And it also meets an unmet need that wasn't met before. And most importantly as well, certainly from the current economic climate, it actually results in a more efficient allocation of resources to the real economy. Because don't forget, we're here talking about asset management and investment services here, and there are basically two groups of stakeholders at either end of the asset management chain. There are the investors, and then there is the real economy. And if the asset management industry fails, it fails ordinary investors, but it also fails the real economy because it is there to supply capital to the real economy as well. So you can only really judge innovation if it actually passes one of those 5 tests. And of course, we also want to make sure that consumers make optimal decisions really about their consumption of products. We don't want them to consume too much debt. We want them to consume more of savings and retirement products as well, so they can look forward to a comfortable retirement. So those are the outcomes that we use to judge whether or not markets are working, and therefore to establish which type of interventions we need to deploy to make markets work. Now, we're here talking about asset management and investment services, okay? So how do we assess or how do we rate asset management and investment services against these tests? Now, I'm afraid to say, if you perform an analysis across asset management, banking, insurance, and what have you, the asset management industry is the industry that actually probably scores badly on every single test that we look at. Much of the financial innovation and quotes that we saw over the past 2 or 3 decades, instead of actually helping people manage risk better, it simply introduced greater risk into the financial markets. What we also seen over the past couple of decades really was a proliferation of products, both horizontally but also vertically along the supply chain. And we didn't see any real innovation in the sectors. As I mentioned there, what we have is an oversupply of firms in many areas, and certainly an oversupply of financial products. But in certain parts of the supply chain, there's a worrying concentration in the markets. But I think the most critical factor really is that if you actually look at the independent analysis of the investment returns produced by the asset management industry. And after all, this is what the industry exists for, is to provide decent risk-adjusted returns. In many of the key member states of the European Union, the asset management industry did not even produce returns that kept up with inflation over the past 10 years. So it has singularly failed in its primary objective to produce decent risk-adjusted returns. I think this has all been exacerbated, of course, by the extraction of value in the form of high surge costs, all the layers of fees we see in the supply chain at the moment, and all the various intermediaries that have been brought into the market, the hedge funds and the funds of funds and and so on. I mean, there's about 11 different layers of intermediaries now that stand between an investor and the real economy. They are all extracting their own fee. They're extracting a cut of people's investments. And the only way they can add value is if they actually result in a higher risk-adjusted return. But as we see, they have not produced decent returns. Therefore, that extraction of value results in a destruction of value for the end user and ultimately for the real economy, because less money is actually getting through to the real economy as a result. And of course, we see overtrading and churning of shares and churning of portfolios as well. And interestingly, the European Commission produces a really, really good document called the EU Consumer Market Scoreboard. And if you look at investment services, it actually comes bottom of the league table. Out of 30 consumer sectors they study, it comes bottom nearly every single year we look at the study. And that's across all member states. It's either very bottom or else in the bottom quartile across all member states every year, year in, year out. So if you think about that, that's the challenge we face. This is how badly this sector is actually performing from a consumer perspective. Now, the next question then, of course, is if we're thinking about the role of investor education here, the next question is to ask ourselves, why does this sector perform badly? What we call the root cause analysis. This is really important here, because you have to sort of get rid of all the preconceptions and all the assumptions about why markets fail and so on, and actually understand the real reasons why markets fail. And if you look at it objectively, then the analysis shows really there's a combination of factors, and I'll just run through some of these, but there are external factors, to be fair. I mean, the asset management industry is particularly vulnerable to external market factors. The financial markets themselves can actually affect conditions. So they're more exposed to external market factors than other markets. As I mentioned, the conventional regulatory philosophy over the past few decades has been quite flawed, because it's been built on the assumption that the job of a regulator is to create the conditions for markets to work and then tackle the information asymmetry problem. And if regulators do that, then the theory is the magic of markets, the hidden hand of market forces, will actually create the right outcomes for our consumers. But again, we know that hasn't actually worked. On the demand side, what we do know is that there are certainly problems around consumer awareness, understanding, and confidence. There's the information asymmetry problem that I mentioned, and then there are behavioural constraints and biases as well. Consumers are notoriously present-centred. They're not very good at deferred gratification. So this is where the investor education or the financial education initiatives come in. But the other big set of factors really are the supply side factors. And again, this is really important to sort of read this slide. I'm sorry if you can't see it, but why it's important will become clear in a moment. On the supply side, what we do see is that there is fierce competition in this market. Now, don't get me wrong, but again, there's a difference between competition that works for consumers and then competition for acquisition or competition for distribution. So there is fierce competition, but it is the wrong sort of competition. The products themselves are sort of designed badly, and they're over complex, and as well as having too many of the products on the market. But I think an interesting one, of course, is that I couldn't find any European data on this, but as a proxy, I found some data produced by the CFPB in the USA, and they estimated that the financial industry, spends $17 billion per annum on marketing and advertising and promotion, and all the public authorities put together spend $670 million per annum on education programs and so on. So that means that the industry outspends the public authorities by a ratio of 25-1 per head of the population in terms of marketing and advertising and promotion. Now, one of the important caveats to this figure is that this estimate here actually excludes spending on retirement products. So if you think about it, the amount of advertising and marketing that the industry spends in the totality of financial services is actually much greater than this. And the significance of this figure is, of course, that any financial education programs or investor education programs are actually fighting a very, very difficult battle against the huge resources that the industry has to influence and drive consumer behaviours. I mean, I doubt very much of the situation is that different in the European Union, as I say, but we couldn't find any data on that. And of course, we have a series of sort of sales practices and behaviours along the supply chain, like rewarding staff for the volume of sales rather than the quality of the sales recommendations as well. It comes back to Gary's point about the sort of fiduciary duty, of course, and all. But I think an overlooked factor as well we found really is that it isn't just the skill factors or the competence of the consumer that matters. It's actually the skills and the competence and the training of the intermediaries and the advisors and the staff who work for firms as well. They are also subject to behavioural biases. And of course, they're even more susceptible to behavioural biases because they're often rewarded by aggressive remuneration strategies, as I mentioned, that reward where they get a higher salary for the amount they sell rather than the quality they sell. So don't forget the sort of the competence and the education of the intermediaries and the professionals in the industry as well. So what can we do about it then? This is really the important thing. Now, if you're a conduct of business regulator, there isn't that much you can do about external market factors. I mean, of course, the prudential regulators can do a lot about it, and the financial stability regulators can do about it. But the conduct regulators can't do that much except be aware and ensure consumers are protected against that. So what can we do about the demand side failures that we identified in the last slide? Well, we can try public information campaigns. Again, I hate to say it, but I mean, I can find precious little evidence that public information campaigns actually work in changing long-term behaviours. We can try information disclosure. Now, if you're an economist, and I don't want to offend economists, but the classical economic theory is built around information and asymmetry, and the remedy or the intervention economists always recommend as well. If you identify information asymmetries, then let's have more information disclosure, and that should level the playing field. But again, I can't find any real significant evidence when it comes to these markets that more disclosure per se actually works in addressing information asymmetries. A good example, again, the UK is a great example. If you want to learn how not to do things, always look at the UK. Because we have such an experience of getting things wrong over the years, and it's particularly important given the size of our market. But we've had disclosure in investments in life and pensions products for decades now, and it had almost no effect in actually bringing prices down or actually making the market more competitive and efficient from the point of view of consumers. Again, I'll come on to this thing about financial capability interventions as well and behavioural interventions. Now, the most effective thing at making markets work actually is supply side interventions. And that includes things like much tougher ex ante regulation as opposed to ex post regulation. Product regulation and product governance is a very effective mechanism of making markets work. And again, contrary to the classical economic theory, product regulation does not stifle financial innovation. It actually improves or enhances financial innovation because it actually just simply drives all the dross or all the waste out of the market, creating a more clear market, which actually makes it easier for consumers to compare and reduces the search cost. A very, very simple thought experiment about this. Just think about the 30 or 40 or 50,000 investment products that are on the market in the European Union at the moment, and imagine what would happen if half those products actually disappeared or didn't exist. I can assure you, the end user, the consumer, would be better off. They would not be worse off if those products did not exist in the first place. So I'm afraid product intervention is a very, very successful way of making markets work. And again, you can have competition interventions, structural interventions, and so on, and then improving the training and competence of the advisors and intermediaries in the market as well, because this comes back to my point I made previously. The real issue here is not the competence and capability of the investor, it's the competence and capability of the intermediary or the agent or the salesperson, because in this particular market, they act as choice editors for the investors. Therefore, if they are subject to biases and lack of competence and lack of skills, then their recommendations are ultimately going to have a detrimental impact on the end user. So the skill and the behaviour and the competence of the market practitioners is more important than the investor. Now, last slide, you'll be glad to know, this is an incredibly busy slide, but this is really, let's talk about the role of financial or investor education stroke literacy. As I mentioned at the start of my presentation, given the scale and the nature of the market failure in the asset management industry and investment services, it is really, really critical that we choose the right mix of interventions and we deploy the right interventions at the right time to achieve the maximum impact, given that we have finite, limited resources. Now, regulators are notoriously under-resourced compared to the financial services industry. So they've got a really difficult job in actually making markets work, given the sort of the resource imbalance they faced. And of course, the new economic climate that we face makes it even more important that we choose the right interventions, because I talked about the sort of the poor value that the asset management industry delivered over the past decade. And that was actually during a period of reasonably favourable investment returns. Going forward, we expect that investment returns will be lower, inflation-adjusted returns will be lower. Therefore, it's going to be even more important that the industry delivers real value for the end user. And of course, for some reason, I still don't understand this, but European policymakers seem to be intent on forcing their citizens to use financial markets to provide for the future, such as retirement. There's no logic to this. This is pure ideology, but there's nothing we can do about it at the moment. This has been driven through at a very high level, but there is simply no logic to this. But if the policymakers insist on forcing citizens to use markets, then we better make sure those markets are actually fit for purpose and are actually efficient and fair and transparent and operate with integrity. Now, this comes back to the question now, where does investor education or capability fit in to this? Now, I should say, at the FSUG, we certainly support the use of financial capability initiatives. That's, as the Americans say, it's motherhood and apple pie stuff. It's hard to object to investor education and stuff like that. But again, looking at the meta-analysis that Gary refers to, it is actually really, really difficult to find compelling evidence that financial education programs actually produce sustained long-term changes in behaviour amongst investors. But I think most importantly, from the point of view of the regulators here, there's actually little reason to believe that financial education programs change consumer behaviour in a way that is sufficient to then change corporate behaviour. This is the really, really important point here. Think about it. If you're a regulator, you can change corporate behaviour in two ways. You can intervene and change corporate behaviour directly, or you can try and influence consumer behaviour so that indirectly they change corporate behaviour. There is no evidence I can find that education works to actually influence consumers sufficiently to actually change corporate behaviour. And I just sort of question really the cost effectiveness of financial education and investor education initiatives. Again, let's just do a simple thought experiment here. Now, let's imagine we have 10 big firms within a single member state, and let's imagine they have 500,000 customers each. Now, again, you can change those firms' behaviours in two ways. As a regulator, you can actually get in and actually force those firms to change their corporate behaviour, or you can try to influence 5 million consumers through education programs in the hope that they will exert competitive pressure on those 10 firms and drive up the standards in the market. Now, I know which one I prefer, given the evidence. More direct supply-side interventions are more effective than long-term, very expensive, costly investor education programs. Now, as I say, we very much support the idea of education and so on, but it's so important to get the sequence right here. The priority should be to clean up the market first, make it more transparent, make it more efficient. It is only then can I foresee investor education ever having a real impact. That has got to be the first sequence. Clean up the market first, then education might stand a chance in raising the standards even further. However, having said that, there is evidence, again, as Gary pointed out, actually he's quite right about this, that there are some behavioural interventions that can influence short-term behaviours in a positive way. But I think this is different to financial capability. But I would argue that if we are going to sort of focus on behavioural interventions, then they should be seen as a defence mechanism. They should be seen as actually a way of warning consumers against the sort of the excesses, the worst decisions. So they should be used to bound the consumer decision. But the most important thing, as I've mentioned here, is that the behavioural interventions should be targeted on the producers, the agents, and the intermediaries. And again, I just want to pose a question, really. Instead of sort of spending more money on financial capability, we would think, well, is it not better to support civil society groups and help them expose bad practice in the market as well? There is a serious imbalance here. Regulators are finding it really, really difficult to police and monitor financial markets, particularly in the wholesale markets and in the institutional markets, where there isn't a strong consumer lobby that actually keeps the markets in check. So I would argue it's better to sort of support that side of the civil society rather than spend money on financial education. And last point, really, I think is really, really important here. We've got to be really careful about this. That financial education, it doesn't become a Trojan horse. I don't know if anybody studied the classics and sort of Greek mythology and so on, but the problem with the Trojan horse is that you have the industry comes along, they support the idea of financial education, but of course some of them have a vested interest because they think if they support financial education, they can persuade regulators and policymakers to ease off on more direct supply side interventions. So that's my 15 minutes. I'm on the sort of say, good. It's a good idea, good in theory, but the reality is at the moment it is having very, very limited effect on changing market behaviour, and that's what this is all about. Yeah. Thank you.